We got a massive trend that's been going on now for years, and under the watch of Victor Werney here at Cboe. How many ETP launches have you overseen, Victor?
Yeah, Oliver. So personally, almost 1,000 at this point. It's been
Wow.
really exciting. I joined the organization back in 2018, where we had roughly 300 ETFs, and we just crossed 1,000 here in the United States just last month.
Amazing. Great to see you. Good to have you here.
Thank you for having
You're
me.
based in New York, but you're here in Chicago a lot.
Absolutely.
What is hot right now that you see? Is it the options-driven stuff in the ETFs that people are getting most excited about? Because that's kind of what I've been getting excited about. Income-driven strategies, people taking all these wild stocks and taking their volatility and generating income out of it seems like a really popular thing.
Absolutely. So as an ETF industry, we're on pace for over 1,000 ETF launches this year alone.
Wow.
And with that, we're seeing 85% of the ETFs come to market be actively managed strategies with 40% derivative-based products. So they're either incorporating options, swaps, futures, whatever it may be. So it's been really exciting to see the increased derivative adoption within the ETF wrapper.
When you were launching 1,000 a year, and I don't know what the IPO count is. I'm pretty sure it's not 1,000. I don't know. I have to check. But if the ETF launch count is moving faster than like the new company count, eventually is like the tail of the dog going to come around in some weird way? Like, how does that work?
It's really interesting. So for every 5 or 6 ETF launches, we're starting to see one ETF closure. So launches are far more outpacing closures. But to your point on the single stock side, we're seeing many ETF asset managers come to market with leverage and inverse strategies, covered call strategies on single stocks. And many of those product strategies are gaining quite a bit of momentum in the ETF space.
So 1,000 a year, roughly, kind of an annual pace right now. One closure for every 5. So, all right. So then we're looking at basically maybe 200 get closed down at that pace. That's a pretty good explosive pace. But from what I understand in the ETF world, it's hard to make it really sustainable if you don't get if you don't get flows pretty quickly. I mean, you can put up your own money, but is one of the results then that ETF shops are going to be demanding higher standards for funds, or what is the implication?
It's really interesting with all these strategies coming to market. Historically, you'll see many core equity, core fixed income ETFs launch. But now asset managers are really looking to diversify their product offerings. And with that, giving them a little bit more of a timeline to catch in the industry. So with that, to your point, we're seeing a lot more derivative-based strategies, people utilizing options in different means. Defined outcome ETFs are a great theme.
Right.
There's now over 400 defined outcome ETFs out there today with a total AUM of 70 billion.
Wow.
So that's a space on the Cboe side we're really on top of with our Flex Options team, our Data Vantage team.
Yeah.
It is a great story for the industry.
Flex Options, Jeff Chang earlier this week at Vest uses a lot of those, I know, for the buffer funds. We just talked with Jason Barcina about the structured products competition. The defined outcome space is ripping right now. What's the argument for the ETFs versus some of the other, approaches to accomplishing that same goal?
I think with the ETF, there's a lot of transparency. You can look in the underlying holdings. You could trade it like a common stock. It's very easily accessible in your brokerage account. Historically, many people would need to access these strategies in a structured note wrapper, whereas the defined outcome ETF is really democratizing that for the average, everyday investor.
That's kind of where, when you think about what's the dream in finance today, if you've got a great idea. Now, for the part of the trailer in this is, if you think you've got the edge, Chicago's the place to make it happen. And back in this could be, you're a prop trader, you're if you want to be a hedge fund manager one day, okay. ETF, is that kind of a path for people to execute a vision, or do you see mostly established big players throwing their weight around? They can say, okay, I can put up 300,000, year one or whatever it costs on average. Is that the case, or do you see it as a place for startups, for newcomers?
It's a combination of both. We're seeing some of the largest asset managers start to get into the ETF space that have been traditionally involved in the mutual fund strategy world, whereas we're also seeing many firms enter the ETF via a lot of these white label service providers that allow them to do SMA to ETF conversions or mutual fund to ETF conversions.
Okay. So, all right. So then you've got a lot of that kind of old money kind of switching over, which makes sense. Is that then the inevitable kind of end of the mutual fund? Obviously, there's some that stick around, but I imagine the standard, if you're a mutual fund, the standard is going higher every year to keep running as a mutual fund.
I think it's an exciting time to be in the ETF industry, especially with multi-share class coming up. which is essentially the tack on of an ETF to a mutual fund product.
What's the next big thing we should be looking for?
Multi-share class ETFs, but also crypto.
Crypto, right?
Crypto's very exciting in the ETF space.
We've got options on crypto stuff that's happening right now too, which is,
yeah.
I mean, I know some of those are listed here as well. Is the idea to not so much get exposure to the underlying, but kind of wrap it in such a way that's more amenable to a different target audience?
Yeah, so here at Cboe, we filed for the first spot Bitcoin ETF in the United States. We list the majority of spot Bitcoin and Ethereum products. And with that, it's really exciting in the options world to be able to now utilize option strategies on some of these spot Bitcoin products. Cboe actually launched an index, CBTX and MBTX, which is essentially an index comprised of various spot Bitcoin ETFs that allows you to trade options on that index.
Okay.
So holistically across the organization, we're constantly looking at innovating in a number of different areas that touch the ETF industry.
As the ETF launches and the targets and the goals of them get a little bit more complicated, and a lot of these are actively managed, are fees becoming less of an issue? Because it kind of used to be, I feel like, when you came from the passive index ETF being the baseline, it was like, how low is your fee? That's what matters the most, and kind of nothing else. And that's what really disrupted the mutual fund world. But does that matter less now that they're addressing more complicated solutions?
You know, Oliver, I'd echo your sentiment there. When I first joined the industry, it felt like from an expense ratio side, there was a race to a little bit to zero. But I'd say with the rise of actively managed strategies, I don't think expense ratio is as much of a conversation point as it was historically.
Okay. But I guess to be competitive, is there still a range? Like, even if you have an active fund, where do you, as an ETF, where do you sense that you're not competitive if you hit a certain rate? Like, what number is that? What is it, above 1%?
It really depends on the strategy. There's so many different unique strategies out there today that are in different areas of the universe that have their expense ratios layered accordingly.
Let's say you've got the most brilliant fund. What can I charge for? Can I tell people, hey, I'm doing 1.2%, I'm doing 1.5, or do they start to go like, all right, why does it cost so much?
There are ETFs with expense ratios like that out there today that do have hundreds of millions in AUM.
Yeah, and they're cranking because they must be doing something very well. The performance, I guess, becomes key, becomes pivotal.
Absolutely.
Love it, Victor. Great